Welcome to This Explainer. Today we're diving into a fascinating, frankly counterintuitive truth drawn straight from our source material. Trading isn't hard, it's misunderstood. We're going to see exactly why the market is not some giant puzzle you have to solve, but rather an engineered behavioral trap designed from the ground up to be survived. If you've ever felt like the market was specifically out to get you, well, you're definitely going to want to pay close attention to this.
Let's kick things off with a pretty brutal statistic. 90% of retail traders lose money. But here's the wild part, right? It's not because the math is too complex for the human brain. No, they're losing because they are walking into a high-stakes psychological war, carrying tools that were literally built to guarantee their defeat.
You've probably been told a million times that you just need more indicators, more study of macro theory, or simply more screen time. But as we'll explore today, that's just not true. The gap between hard and misunderstood is quite literally where most trading careers quietly die. The problem isn't a lack of effort, and it's honestly not your fault. The problem is the fundamental lens through which you're viewing the market.
Section 1. The Great Trading Myth.
Think about how most folks start trading. They fire up a demo account, hunt around for a strategy, and off they go. But nobody stops to ask the new trader the one absolutely crucial question. Who is actually on the other side of my trade? And what do they know that I don't? Being able to answer that honestly is what separates just gambling with extra steps from trading with a real, verifiable edge.
Section 2. The Support Line Trap. Okay, picture this. You're looking at your chart, and you spot this perfect horizontal level with 3 crisp bounces in a row. Bam! Dopamine hit. Human brains absolutely love pattern recognition. We want to see a safe, mathematical floor that the market has agreed to respect. But here's the reality check. The market has no memory, and it owes your little line absolutely nothing. The only reason that line matters is because thousands of other traders drew the exact same one.
Let's walk through how this usually goes down. You buy in on that anticipated fourth touch, and you tuck your stop loss right where the textbooks tell you to, just under the line. Price creeps down toward the level, your palms are sweating, you're hoping it holds, it touches the line, hesitates for just a heartbeat to give you that false sense of validation, and then rips violently straight through it. Stop triggered. But then, almost cruelly, the price reverses immediately and explodes in your original direction, without you. Section 3. How institutions hunt liquidity. When you get stopped out like that, it really feels like some invisible hand is out to get you personally. But it's not personal at all, it's entirely structural. You've got to look at the contrast here. How do retail traders see a support line? They see it as a safe floor. But how do institutions see it? They see it as a dense, highly predictable pool of forced sellers.
You have to put yourself in the shoes of a massive institutional player for a second. These entities are moving hundreds of millions, sometimes billions of dollars. They can't just click buy for 10,000 contracts at market price. If they did, they'd completely vaporize the available supply and suffer absolutely brutal slippage. As our source beautifully describes it, it's like trying to pour the ocean through a garden hose. The sheer size of their order is the problem. So to get those 10,000 contracts filled without tanking their own price, they literally need 10,000 willing sellers sitting right there. And where do those sellers live? Right underneath that textbook retail support line. Every single retail stop loss tucked under there is functionally an automatic sell order. To the big algorithms, that's just a wall of guaranteed liquidity. It's free inventory sitting on a shelf, ready to be bought up in seconds.
Section 4. The LSR 14 Framework.
So, how do we survive this? We have to completely ditch the subjective guesswork and rebuild our approach from the institution side of the glass. The liquidity sweep and reclaim framework strips the emotion right out of the process in 4 exact steps. Step 1. Spot a structural swing low that's been tested at least twice, 15 or more periods apart. Step 2. Totally ignore the direct retest, because that's the retail trap we just covered. Step 3. Wait for an engineered sweep that dips below that low by 0.5 to 1.5 times the ATR. And Step 4. Watch for the price to reclaim that original level within 2 periods. If 2 traders follow this, they're taking the exact same objective trade.
Now, you might be wondering about that ATR part, the 14-period average true range. This metric does the heavy lifting that static lines just can't do. It dynamically adapts to the current volatility of whatever instrument you're trading. Quiet Tuesday? Wild news event? It doesn't matter. The thresholds move with the market. If the sweep is a shallow blip, big money hasn't transacted yet. But if it goes way too deep, well, that's a genuine trend shift, not a stop hunt. The ATR mathematically keeps you out of both of those traps.
Section 5. Trading the sweep.
Let's actually see how this plays out on a real chart, applying this to a 1-hour setup on the GBP/USD.
Here's our data. We've got a clear double bottom sitting right at 1.2650. The ATR is currently 20 pips. So, doing the math, our acceptable sweep zone, meaning half an ATR to 1.5 times the ATR, objectively sits between 1.2640 and 1.2620. Anything falling in that 10 to 30 pip pocket is game. Anything outside it, we completely ignore it.
Okay, so the price suddenly drives down hard, hunts those retail stops, and prints a swing low at 1.2635. That is a 15 pip sweep, which sits perfectly and cleanly right inside our required 10 to 30 pip zone.
Now, right at this exact moment, all the retail breakout traders are absolutely panicking. They're shorting your breakdown, totally convinced they've caught the next massive leg lower. The headlines are probably calling for a crash, so what do? We do absolutely nothing. We wait for confirmation. This framework wasn't built to predict the sweep, it was strictly built to react to it. So, we just watch.
And then, there it is. The very next candle dips just a bit lower, and then violently reverses, closing all the way back above our original level at 1.2665. That right there is the reclaim. It mathematically proves the institutional footprint within that two-period window. The market is basically screaming at you that the sweep was just a transaction to fill someone much, much bigger than you.
Which brilliantly illustrates our actual trade setup. We execute a market buy right on that close at 1.2665. Stop loss goes just below the sweep wick with a tiny 5-pip buffer, placing it at 1.2630. That gives us a total risk of exactly 35 pips. We target the prior structural high up at 1.2753. Boom, a calculated reward of 88 pips, or better than a 2.5 to 1 payoff with absolutely zero guesswork. You're literally aligning your entry with the exact liquidity event the institutions just engineered.
But before we wrap up, there's one critical final piece you have to remember. These mechanics are fantastic for aligning you with institutional sweeps, but honestly, no framework survives forever if you're swimming against a massive opposing force. If you master this exact setup, but trade it blindly against the larger macro order flow, your account won't blow up all at once. It's just going to slowly bleed out, one paper cut at a time. So to really survive this behavioral trap, I want to leave you with one vital question to ask yourself before taking your very next trade. Which direction is the bigger river actually flowing?